Hello, my name is Magnus Petersen. This video is about so-called volatility harvesting, where we want to test whether we can earn excess returns on a portfolio of stocks by merely rebalancing the portfolio at regular intervals compared to simply buy and hold of all the portfolio stocks. This would be extremely attractive in today's markets, where the trading fees are nearly zero for US stockbrokers, so we would be able to rebalance very large portfolios on a daily basis or even multiple times per day, and this could even be automated by the stockbrokers' computer systems. The claim that rebalancing earns excess returns over simple buy and hold portfolios goes back to a paper from 1992 by David Booth and Eugene Fama. Booth went on to become a very wealthy investor, and Eugene Fama later won a Nobel Prize in finance. Since then, many other journal papers have made similar claims, but I had to read maybe 10-15 papers, and I still couldn't get a clear and convincing answer whether it really works. Although these papers are mathematical in nature, they are very unclear about their assumptions and how they limit their validity to certain scenarios. They are written in the typical, arrogant academic style, where many of their claims are really more like assertions and conjecture rather than solid proofs. It probably only took me a day to test whether rebalancing a portfolio has the benefits that the academic papers claim. I then debated with myself if I should write a paper to share the results with others. I decided to do it because it would have saved me a lot of time if someone had written a paper like this, so I didn't have to read 10 to 15 academic papers with incorrect claims. It probably took me almost a month to extend my research, polish the computer code, and write the paper. And just recording and editing a video like this takes a whole day or more. I think the video will only be viewed by maybe 500 people, and I estimate that only 10% of those people are actually watching a substantial part of the video. So I am always asking myself if it is really worth my time and effort. But when you can no longer trust academic research, the rest of us will have to share our knowledge with the world. I want to talk a bit more about academia and politics, but there is a link below the video if you want to skip this part and go directly to the main content of this video. Especially in the last few years, the political left has increasingly used dubious academic claims as weapons against their political opponents by saying anybody who disagrees with their politics is therefore also anti-science and irrational. But fact is that you cannot trust a lot of academic papers. We will see in this video that you can't even trust a Nobel Prize winner's academic papers. And while I do agree that academic finance is exceptionally bad, it is a general problem in academia that you cannot trust the journal publications. Anybody who has been a part of the academic publication process knows that a journal review does not in any way guarantee that a paper is correct. Reviewers do not repeat the experiments of a paper. They merely comment on the writing style, whether there are other papers that might be relevant, and whether another methodology might be useful. In case of pure mathematics, the reviewers ought to go through the mathematical proofs and see if they are correct, but you can't even trust that they have done that. What I do instead is that I publish all the computer code and datasets for my research, so everyone can repeat all the experiments and see for themselves if I have made any mistakes. This makes everyone a reviewer of my work. You can also very easily build on my results and use my computer code on your own datasets. This is the way academic research should be done, but very few people in academia actually do this. As I have spoken about in my previous video series on why academia sucks, another main problem with academia is that people are basically employed for life. Even if they don't have tenure, it is very rare that people in academia get fired. If a university would just get rid of the bottom 10% of their employees every year, then within a decade they would dramatically improve the quality of their research and teaching by allowing young and energetic people to get a chance and keeping the ones who do great work and getting rid of the ones who don't. But the problem is that academia has been specifically constructed to protect the jobs and egos of the professors. Another result of this is that people in academia will almost never hire somebody who is better than themselves. They always hire people who share their beliefs and are slightly less competent than themselves. So the established professors will maintain their status and they won't have any competition when applying for grants, and their own work won't be proven wrong by the new professors that they hired. This means that over generations, academia has devolved into a factory of indoctrination and conformity, both in regards to scientific research as well as politics. The purpose of academia is no longer the pursuit of truth. Let me give you a few recent examples. It has now become common that university professors claim that men can have babies, because a woman who thinks she is a man is actually a real man, only with a vagina and a womb instead of a penis, so therefore a man with a vagina can now have babies. This is like a Monty Python joke from 50 years ago that has now become reality because of Western academia. It has also become common for university professors to claim that mathematics are inherently racist. All this is of course complete insanity, and the list of absurdities goes on and on. In recent years, this has also spilled into the real world, where the political left is using the lunacy of academia to claim their policies are based in science. For example, we now see young children, especially young girls, starting gender reassignment with hormone treatment and eventually undergoing surgery to remove their breasts and mutilate their genitalia, because academia and the political left has made young children so confused about their gender and claiming it is science. What the political left and Western academia is doing now is not just insanity, it is pure evil. And the few real scientists who are still in academia are basically cowards who don't dare to speak up against this insanity, even when they are protected by tenure. So you should now expect that much of what is published in academic journals is actually pseudoscience, and the social sciences are basically just a hidden Marxist agenda to destroy Western civilization. Fortunately, I don't think Western academia is going to survive much longer. In 10 years, you will be able to get a much better education on the internet, and in 20 years, nobody will take Western academia's so-called research seriously anymore. Western academia is in a very deep crisis, and the only solution is to replace most of the faculty. But that is not going to happen, because they have specifically constructed academia to protect their jobs and egos. So Western academia is now in a death spiral it cannot escape. Okay, so let's begin with the main content of this video. What we have here is the original paper from David Booth and Eugene Fama called Diversification Returns and Asset Contributions. In my opinion, it is very poorly written. First of all, it is unclear what they mean with the definitions, and then they make a number of mathematical transformations, and it is even more unclear what are the underlying assumptions and limitations in making these transformations. But when you play around with these formulas and you kind of think you understand it, and you make various assumptions about the volatility of your individual stocks and so on, it looks really good what you can achieve by doing daily rebalancing on your portfolio if you trust what this Nobel laureate in finance has written in this paper. And there are probably at least 10 other papers that repeat these claims that you can earn an excess return from simply rebalancing your portfolio at regular intervals. There are also a few papers that are very critical about this, and this is one of them. And I particularly like this paper because it is quite, maybe not harsh, but it's definitely strict in saying how all of the others are confused, and I like that. I think that's funny. But I will say that this is also not a completely convincing paper, because it also has these long hand-wavy arguments with mathematics where it's not really clear what the assumptions are and the definitions and limitations and conclusions and so on. So there are a lot of claims in this paper that also read somewhat like conjecture or mere assertions. This is right because we say it is right. Like that, the typical academic writing style, and simply not convincing. So this is my paper, and it is around 90 pages, but most of it is actually plots. And there's not that much text in the paper, and the text is fairly easy to understand. But my point in making this video is that in, I don't know, let's say half an hour, I can tell you what are the main conclusions from this paper, and you can go into the paper and read the details yourself. So here are the contents of the paper, and I'm not going to make any formal mathematical analysis of the problem. I'm going to define it mathematically, as we will see in a moment, but I'm not going to try and analyze it and say either rebalancing or buy and hold is better than the other. What we're going to do instead is we're going to make entirely empirical analysis. So we're going to make thousands of random portfolios, and simply test to see which one is better than the other. So first we need to define the problem mathematically so that we know exactly what it is that we want to calculate and compare. And this is basically just like the asset return is the asset price in the current time step divided by the asset price in the previous time step. And the asset's cumulative return is just the product of all of these time steps. Or we can say it is the final asset price divided by the first asset price. And when we have a buy and hold portfolio, we essentially take a number of assets, for example, stocks from America, and we buy each of those and we hold them for, let's say, 10 years. And we let each stock run its course. And then after 10 years, we're going to take the average of those stock returns. And we're not going to do any rebalancing in the years between. So this is what we mean by the buy and hold portfolio. And this is the formula for calculating it. I'm going to show you on the real data in a moment so you can see more intuitively what it is that we are calculating, because the formula can be a bit tricky to understand. But the main difference between the buy and hold portfolio and the rebalanced portfolio is essentially the order of the summation and the product of these individual asset returns. So when we have the buy and hold portfolio, we first calculate the cumulative asset return, and then we take the average of that. And then when we have the rebalanced portfolio, we do the opposite. In each time step, we first take the average of the asset returns, and then we take the product of all those to get the portfolio's cumulative return. So let's try and go to the source code. And this is a Python notebook, so you can download this, and it will automatically download all of the data, except for the intraday data. You have to enable that download manually, so it doesn't download it all the time. But the daily stock returns will be downloaded automatically the first time you run this notebook. So let's try and look at the daily share prices. It goes back to the year 2007 until the beginning of the year 2021. Not all of the stocks have data going back that far. So in the cleanup process, we're going to remove that data, and we're also going to remove data for stocks that are very small or stocks that have extreme returns from day to day and various other things. But we basically have a matrix like this where we have the stock tickers as the column names up here, and then we have the dates in the rows. So from the daily share prices, we can calculate the daily returns. We simply take the share price for time step T and divide it by the share price for the time step T minus 1, so the day before. And here for stock ticker A, we have these stock returns here. And notice that these are all plus 1. And that is because otherwise we would have to add 1 in many of the other calculations further below. So what this means is that the return from the 3rd of January 2007 until the 4th of January was 1.003085, which means a 0.3085% return on stock ticker A. The next day, it was 0.990773, which means there was approximately a 1% loss. So you have to subtract 1 and then multiply by 100 in order to get the percentage return from day to day. So what does it mean to have a buy and hold portfolio versus a rebalanced portfolio? Well, in the buy and hold portfolio, we buy different stocks. Let's say we buy this one A, and this one AAL, and this one AAME. So we have 3 stocks. And then we calculate for each stock individually the cumulative or the compounded return. So we take this number here, multiply it with this number, multiply it with this number, multiply it with this number, and so on. And we do that for the other stocks in the portfolio as well. So this number multiplied by this, and so on, and the same for this stock. So this lets the stocks run their course by themselves. And then for some time step T, let's say after 10 years, we take the average of whatever those numbers have become. So let's say this stock has maybe increased 10-fold, this stock has increased, let's say 5-fold, and this stock has decreased to, let's say, half of what it began at. So then we take those final values and take the averages of those. The rebalanced portfolio does it differently. Let's say we have the same 3 stocks. So on each day, first it takes the average of those daily returns. So this number here, this number here, and this number here. It takes the average of those 3 daily returns. And this is the daily return for the portfolio for that day. And for the next day, we do the same. We take this number here, and this number here, and this number here. We take the average, and that is the return for the portfolio on that day. And on the third day, we do the same, and so on. So we get all of these average numbers for the daily returns, and then we compound those together or multiply those, and that is the cumulative return of the rebalanced portfolio. And what we then do is we generate thousands of random portfolios where we compare the rebalanced to the buy and hold portfolios. So we take random stocks and we take random start and end dates because the results might be different depending on the particular stocks and the particular start and end dates. Okay, so let's go back to the paper. In the paper, I have written a few simple examples where we only consider two different assets. These could be stocks or currency pairs or whatever. I simply call them asset A and asset B. And depending on how these behave relative to each other, we can see whether the buy and hold or rebalanced portfolios are better. So in this example, the asset A increases and decreases in this zigzag pattern, while asset B simply decreases by 10% on each time step. And in this case, we see that the buy and hold portfolio is better than the rebalanced portfolio. And this is the next simple example. Now asset B increases by 10% instead of decreasing in each time step. But we see the same result, namely that the buy and hold portfolio is better than the rebalanced portfolio. So we might think from these two simple examples that whenever we have a trending asset, the buy and hold portfolio is better. But as it turns out in the real world data, this doesn't actually seem to be the case because the real world data is much more complicated. And here's another simple example where the two assets are both zigzagging back to their previous values. So after two time steps, the two assets are back to their starting value. So the cumulative return after two time steps is always 1. But here we see that the rebalanced portfolio is better than the buy and hold portfolio. And here we see another example where the two assets are zigzagging in opposite directions. This example is different than the one before because now the arithmetic mean is 1 for two time steps, but that means that the compounded return is actually below 1. And I describe in more detail in the paper why this is, but this has to do with the difference between arithmetic mean and the so-called geometric mean. But anyway, in this simple example, we also see that the rebalanced portfolio performs better than the buy and hold portfolio. So from these simple examples, we might conclude that when we have reverting asset prices, the rebalanced portfolio performs better, but when we have trending asset prices, the buy and hold portfolio performs better. But as we will see, this does not hold on real-world data, which is much more complicated. Sometimes it trends, sometimes it reverts in very complicated patterns, and the stock prices are correlated and the correlation change over time. So the real stock data is very complicated, and we see that this doesn't really seem to be the case on real data. So first we use the daily returns that I just showed you in the source code a moment ago. And the data set that we're using has something like 2,600 stocks, but I remove a lot of the stocks that have either very low daily trading volume or they have extreme swings in the daily stock prices or some other problems. And we end up with around 900 stocks. And at the very beginning of the data set in 2007, there's only around 870 stocks in the data set. And then in the year 2009, we have around 923 or something. And we have that number of stocks until the end in early 2021. So this is the data set we are operating with. And there's an appendix in this paper which shows you all of the stock tickers that we're using. So you can see if the ones that you might be interested in are included here. Otherwise, you can rerun all of the computer code with your own data set. So this is what it looks like when we take all of these cumulative daily stock returns and plot them in the same plot. So in this plot, we have Microsoft, which is one blue line, and we have Amazon, which is another blue line, and we have McDonald's and Coca-Cola, and probably most of the popular stocks are in this data set. So this is basically just the total return. So the stock prices being adjusted for stock splits and for reinvestment of dividends, assuming that there are no taxes and the dividends are reinvested immediately into the same stocks. So that is what each of these blue lines show, and all of these have been normalized to begin at 1 and then plotted in the same plot. And then we get all of these blue lines here. The red line is simply the arithmetic mean at each time step. And notice that the y-axis is logarithmic because many of these stock prices have a sort of exponential development over these 14 years. So now let's look at some random portfolios. This plot here compares the rebalanced versus buy and hold portfolios. So let me explain what this plot here shows. We generate 1,000 random portfolios with 5 stocks each. We are using equal weights for the stocks. We are then calculating the cumulative returns for the rebalanced and buy and hold portfolios, and then we are dividing those with each other. So remember that both the stocks that we're choosing for each portfolio and the start and end dates are chosen randomly. So some of the portfolios might start here and end here, or start here and end here, or start here and end here, and so on. And some of them will also start around at the beginning and finish around the end. So the ratio here is showing us when the rebalanced portfolio was better than the buy and hold portfolio. If the ratio is higher than 1, then the rebalanced portfolio was better. If the ratio is below 1, then the buy and hold portfolio was better. As we can see, there is no general tendency that one type of portfolio, either rebalanced or buy and hold, was better than the other. It actually looks at half of these blue lines are above the dashed black line here. So the blue lines above that means the rebalanced portfolios were better, and the blue lines below that means that the buy and hold portfolios were better. And as we can see, it's basically all over the place. There's no consistent tendency here. Maybe something here around 2009, maybe something here around 2016, and maybe something here around 2020. But let's get back to that because it will become more clear in other plots. So below this plot, we also have a histogram, and this basically just shows the distribution of the length of the random portfolios. So on the x-axis here, we have the number of investment periods, so 3,500. I guess this corresponds to 14 years of data with around 250 data points per year, because there's around 250 trading days in a year. And as we can see, we have more and more random portfolios with shorter investment periods. And the reason that the histogram is shaped like this is because of how I have implemented the random sampling of the portfolios. It first takes a random start date, and then it takes a random end date between that start date and the dataset's actual end date. And it also ensures that the investment period has a minimum length, so it's not just 1 day. I can't remember exactly how long it is. Maybe it's a year or so. I can't remember. It has been a while since I actually wrote this code, maybe a month ago, because I had some other work I needed to finish before I could make this video. So here we have a similar plot as we saw before with random portfolios, but now instead of having 5 stocks in each portfolio, we have 50 stocks. But we still have 1,000 random portfolios, they are still equal weighted, and the start and end dates are still randomly chosen. Once again, we see that there's no general advantage to either the rebalanced or buy and hold portfolio, because that would mean that all of these blue lines should either be above or below the dashed black line here. But now we see more clearly that the period here in 2009 and maybe here 2016 and 2021, that those are actually different. Something was happening here. And what is happening here was the so-called financial crisis, where the stock markets crashed tremendously and then they recovered. And what we will see in a few moments is that it looks like maybe the rebalanced portfolio has a tendency to perform better when the stock markets are recovering. And here, towards the end of 2016, we also had a small semi-stock market crash, nothing like 2009. But the bulk of the blue lines now are below 1.0, meaning that the buy and hold portfolios were generally, not always, because there's also plenty that are above, but it looks like the buy and hold portfolios had an advantage here. And here in the beginning of 2020, we had another big and very quick crash when the whole corona crisis started. And it looks like that the bulk of those blue lines are again below the dashed black line here, meaning that the buy and hold portfolios were generally better than the rebalanced portfolios in this crash here as well. Now, what about the recovery? Because the stock markets recovered fairly quickly. But this is towards the end of the data set, and this has not been sampled so frequently by my sampling algorithm that gets the data for random portfolios and the random start and end dates. But it looks like to me that the bulk of these blue lines here are also above the 1.0 line, meaning that in this recovery here, it looks like the rebalanced portfolios also perform better than the buy and hold portfolios. So again, this is something we will return to in a moment because we have better plots and better statistics to show this. But let's just look at another similar plot where now we have random portfolios with 100 stocks and again 1000 trials and equal weights. And we see the same tendencies that we cannot say for the whole period that either rebalanced or buy and hold was better. But in certain short periods like here, 2009, 2016, early 2020, the tendencies seem to be even more clear that when the stock market is crashing, the buy and hold portfolio seems to be better than the rebalanced portfolio. And then in recovery like 2009 and late 2020, it looks like the rebalanced portfolio was better. Now, another thing we should note in these plots is that if we compare them with each other, so here we have for portfolios with 100 stocks, and note that the bulk of these blue lines are limited within 1.1 and 0.9, and here it went down to 0.8, but most of it is within 1.1 and 0.9. So the difference, the relative difference between the rebalanced and buy and hold portfolio mostly ranges between 0.9 and 1.1. Now let's go back to the plot where the random portfolios only have 5 stocks each. And note that the bulk of the blue lines now range between 0.75 and at least 1.25, maybe even more. This is because when we have only a small number of stocks, sometimes those stocks happen to be particularly suited for either rebalanced or buy and hold portfolios for that particular moment in time. So we see much more extreme differences between the rebalanced and buy and hold portfolios. But when we have 100 stocks, they tend to sort of average each other out. So even though some of the stocks are particularly well suited for, let's say, rebalanced portfolios in the given period, other stocks will balance that out because they are particularly suited for buy and hold portfolios. And if we go back to that plot, we see that it is only in particular periods where a large part of the stock market is moving in one direction or the other. So that even if you have a fairly large portfolio with 100 stocks, most of those will move in the same direction and therefore be particularly suited for either rebalanced or buy and hold portfolios. So now let's look at some of the more detailed statistics for all of these random portfolios that we are generating. And those are shown in plots like this. And we have a lot of plots that look like this. I'm just going to show you a few of them so that I can explain to you what the plots are actually showing. Then it is much easier for you to read the paper and quickly understand what the plots are showing. So these are so-called box plots. And let us first focus on the x-axis, which shows the number of stocks in the random portfolios. So here we have for 2 stocks in the portfolio, 5 stocks, 10 stocks, 20, 40, 60, and so on. What this means is that for 2 stocks, we generate 1,000 random portfolios, meaning that each portfolio has 2 randomly selected stocks, and the start and end dates are also randomly selected. In the title of this plot, we see that we are comparing the arithmetic mean. So we calculate the arithmetic mean for the daily stock returns for all of those portfolios, for the rebalanced and buy and hold portfolios. And then we get a distribution with 1,000 data points for the rebalanced portfolios and the buy and hold portfolios. That is the arithmetic daily mean for each of those 1,000 random portfolios. And the box plot here then shows the distribution. So the line in the middle is the median. Then we have the quartiles here, and then we have outliers as well. And the blue box is for the rebalanced portfolio, and the orange box is for the buy and hold portfolio. These show and compare the distribution of the arithmetic mean for the daily returns of all of those random portfolios when we are either doing daily rebalancing or we are simply buying and holding those stocks. And it looks like that the arithmetic mean daily return is slightly higher for the rebalanced portfolio compared to the buy and hold portfolio. But it's not very scientific to just look at a plot like this and compare it. That is what statistics were invented for. And the white numbers we see is the difference between the means. So this gets a little complicated. If it wasn't already complicated, it gets even more complicated now. So what we are first calculating is the mean of all of those arithmetic means for the rebalanced portfolios and for the buy and hold portfolios, and then we are subtracting those means. Note that the line here in the middle is the median. It is not the mean. So the difference between this line here and this line here is actually the difference between the medians of those distributions, where the number we show as white text is actually the difference between the means of the distributions. And if we want to make it even more precise and even more confusing, it is the arithmetic mean of the arithmetic means. This is very confusing, I know. But basically what we are showing with this white number here is that on average, do the rebalanced portfolios tend to have a higher value than the buy and hold portfolios. So this number is 1.3 multiplied by 10 to the power of -5. So it's actually a very, very small number. And that is because we're considering daily returns, which are already small, and the difference between rebalanced and buy and hold portfolios is actually very, very, very small. But the rebalanced portfolios are slightly higher. They are a tiny bit higher because this is positive. If they had been negative, they would have been slightly higher for the buy and hold portfolios. The question is then whether this is a so-called statistically significant difference. And statistics is my Achilles heel. I'm not very good at statistics. I actually never took a course in statistics, but I never took a course in finance either. I just learned it by myself by reading books and then thinking about it and researching it and so on. But to me, statistics is a very counterintuitive and convoluted way of thinking. I recently learned how to do Bayesian statistics, which is a lot easier. It's more like computer modeling and then running simulations. But so-called frequentist statistics is very strange to me. So what I have done here is I have used what is called a paired t-test. So as I understand statistics, it is better to use the paired t-test than a regular t-test. So below this plot, we have another plot. And this plots the p-values for these paired t-tests. What it means is that when the p-value is close to 0, the white number that we see up here in the box plot, which is the difference between the averages of the rebalanced and the buy and hold portfolios, that is statistically significant. And we see that the p-values are very close for portfolios of 2, 5, 10, 20, 40, and 60 stocks. But then for portfolios with 80 stocks, it becomes 0.1, and here it becomes 0.8, and so on. These are not statistically significant. This means that the white numbers up here, they are so small relative to the overall distributions that we cannot say that these are really significant. In other words, this tiny, tiny difference can just as well happen by random chance. But for the smaller portfolios, there seems to be a positive advantage for the rebalanced portfolios. And if you read the text, I have calculated what these small differences correspond to on an annualized basis, so that if you have a portfolio with, let's say, 10 stocks, then on average, how much would this daily difference between the rebalanced and buy and hold portfolios correspond to? And it's less than half a percentage point on an annualized basis if you rebalance a portfolio every single day. But that's not the end of the story, because the next plot shows it for the period between the years 2010 and 2021, whereas the plot before was for the full data period between 2007 and 2021. So now we have excluded the 3 years for the big financial crisis around year 2008 and 9. Now we see that most of these p-values, regardless of the portfolio size, are so high. They are 0.75. So this means that the differences here between the rebalanced and buy and hold portfolios in terms of their arithmetic mean daily return, the difference is so small that it's not even statistically significant. So the rebalanced and buy and hold portfolios, there's really no difference in terms of the arithmetic mean daily return. So let's look at the next plot, and this is for the 3-year period between 2007 and 2010. And now all of the p-values are very close to 0. So these white numbers here, the average difference between the rebalanced and buy and hold portfolios are highly statistically significant, where on average the rebalanced portfolios had a higher arithmetic mean daily return than the buy and hold portfolios. So in this 3-year period, on average, we can say that the rebalanced portfolios were indeed better than the buy and hold portfolios. It would be nice to know what is the reason, and as we will see in one of the following plots, it looks like it has to do with market crashes and recoveries. So this is the next plot, and this compares for the geometric mean instead of the arithmetic mean, and this is for the full period between 2007 and 2021, and as we can see on the p-values, a lot of these are not even statistically significant either. Here is the next plot, and this compares the standard deviation for the daily returns of these random portfolios. And there are a few things that are interesting here. The first thing we really need to check in all of these plots is whether the p-values are statistically significant. And in this case, they are all very close to 0, so they are highly statistically significant. But one of the interesting things in all of the academic papers on this topic is that a lot of them claim that the standard deviation is actually lower for the rebalanced portfolios. But when we test this on all of these 1,000 random portfolios, we have 1,000 random portfolios for 2 stocks, and another 1,000 random portfolios for 5 stocks, and yet another 1,000 random portfolios for 10 stocks, and so on. And all of them show us that the rebalanced portfolios actually have a higher standard deviation on average than the buy and hold portfolios. So that's opposite to what the academic papers, which are doing this mathematical analysis using advanced Taylor expansions and logarithmic transformations and whatnot. But when we actually run the experiments, we see that those sophisticated mathematical analyses were actually wrong. In reality, it looks like the rebalanced portfolios have a higher standard deviation than the buy and hold portfolios. That's interesting. And here we have a comparison of the Sharpe ratio. I never use the Sharpe ratio. People say it shows you the average return relative to the risk you have taken. But the problem is that the standard deviation doesn't really measure risk. It measures volatility. It also doesn't measure forward-based risk. What is the risk of a loss in the future? It just measures the historical volatility over the last year or 2 years or 10 years or whatever. And that may not have anything at all to do with the risk of loss over the next 1, 2, 3, or 5 or 10 years in a particular stock. So I don't use the Sharpe ratio, but I knew that if somebody reads this paper, they would want to see the Sharpe ratio, so I included it. And once again, we of course have to just check the p-values, and we see some of these are not even statistically significant. Now we get to a more interesting plot, and this compares the max drawdown for the portfolios. Imagine that you have the highest point for the portfolio value relative to the subsequent lowest point. So how much have you lost at maximum? And you will note that some of these data points are quite high. They are quite close to 0, which means they have had almost no loss. And that is because you have to remember that the start and end dates for the portfolio are also chosen randomly. So it's not all of these random portfolios that cover a period with a crash, whether it is in 2020 or 2016 or 2008 or whatever. What we are interested in is comparing the distributions for these random portfolios when we are either doing the rebalancing or buy and hold. Once again, the first thing we need to check is the p-values, and we see that these are all very, very, very close to 0. So the average differences between rebalance and buy and hold is highly statistically significant. And we see on the white numbers that these are negative, 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 negative. They are all negative, which means that on average, the rebalanced portfolios did worse than the buy and hold portfolios. It was not a gigantic difference, but there was a significant difference. Now the next plot compares the opposite. This is what I call the max pull-up. So this is only for a sliding window of 1 year, because otherwise we would get the full rise in some of these stocks, and some of them have increased 100-fold. And we are really only interested in stock market recoveries and short rallies and see whether the rebalanced or buy and hold portfolio is better. Once again, we just have to check the p-values. They are all very close to 0. So the differences between rebalanced and buy and hold are statistically significant. And the white value shows us that the difference is actually quite large for some of these. So let me just translate these to percentage numbers. So this is 8.4% difference. This is 10% difference. This is 8.5% difference, 6.7% difference, 5.8, 5.3, 4.5% difference, and the lowest is a difference of 4 percentage points between the rebalanced and buy and hold portfolios. So the difference is higher for smaller portfolio sizes, but here it is actually quite large. So it looks like from the previous plot that when the market is crashing, the rebalanced portfolios perform slightly worse than buy and hold, but when the market is recovering again, or when the market is rallying, the rebalanced portfolios perform significantly better than the buy and hold portfolios. And this is interesting because it is counterintuitive relative to the simple examples that we saw at the beginning, where it looked like that whenever we had trending asset prices, buy and hold was always better than rebalanced. And it turns out this doesn't seem to be the case. It looks like when the stock market is recovering or rallying, rebalanced portfolios tend to perform better. So the lesson that we can learn here is that we should probably not rebalance our portfolio while the stock market is crashing. We should wait until it looks like it has hit bottom and starts to recover, and then we should rebalance at regular intervals. And I can show you the plots in a moment for weekly rebalancing intervals instead, which seems to be even better than daily rebalancing for some unknown reason. But of course, the problem is then to call the bottom of the stock market, which can be very difficult. But it definitely looks like it's an advantage to rebalance during stock market recovery and rallies. So now let's look at the weekly stock returns, and this has just been downsampled from the daily stock returns. And there are some caveats in doing this, especially when it comes to max drawdown and max pull-up. We're not going to look at all the plots for the weekly returns, but we have all the same plots that we had for the daily returns. Let's just look at the ones for the max drawdown and max pull-up. So we have the one for our max drawdown here, and we check the p-values are close to 0. They are. So the difference between rebalance and buy and hold is statistically significant. And once again, we see from the white numbers and the box plots here that the rebalanced portfolios tend to perform slightly worse during stock market crashes than the buy and hold portfolios. So the same as we saw with the daily stock returns. And here we have the plot for the max pull-up. So this shows us how much we're gaining during stock market recoveries and rallies. And again, we just check the p-values. They're all close to 0. So the differences are statistically significant between rebalanced and buy and hold. And once again, I will convert these white numbers to percentage numbers. So for a small portfolio size with only 2 stocks, the average difference between rebalanced and buy and hold is 14 percentage points. That's a lot. For portfolios with 5 stocks, the difference is 8 percentage points. And most of them are around this. And the lowest difference is for portfolios with 10 stocks. And here the difference is only 7.5 percentage points. So the weekly rebalancing seems to be a lot better than only daily rebalancing. However, the caveat is that in order to make the source code very simple, rebalancing is only done once a week. So let's say from Monday to the next Monday to the next Monday and so on. It is possible that these numbers would change if we rebalanced on the Tuesdays instead or on the Wednesdays instead. So we have made the same experiments with monthly returns and annual returns, but I'm not going to go through all of those plots here. So let's go to this section here. This is about intraday returns with 1-minute intervals. This is a very small data set of only 70 stocks, and it only covers 9 days in March and early April. So you can see this is when I actually wrote this paper, and we are now in late May. So it's almost 2 months ago that I actually wrote this, but I had other things I needed to do before I could finish it. And this plot here shows all of the cumulative returns for the individual stocks, and the red line is just the average as usual. So the individual stocks returns for these 70 stocks, some are up and some are down, but on average, they are up maybe something like 2% over this 9-day trading period. Because these are 1-minute intervals, there's actually something like 3,500 data points. So the idea is that we're going to rebalance at each 1-minute interval and see if that works. So here we have the plot for random portfolios with 5 stocks each, and we have 1,000 random portfolios, and we have equal weights. This is the ratio between the rebalanced and buy and hold portfolios, and if it is exactly 1, it means they perform exactly the same. If it is above 1, it means the rebalanced portfolio was best. If the ratio is below 1, it means that the buy and hold portfolio was best. And for these random portfolios with 5 stocks each, Some are better, some are worse, so we cannot say that there's a general advantage to either rebalancing or buy and hold for random portfolios with only 5 stocks. So this plot is for portfolios with 10 stocks, and towards the end we see that the bulk of these blue lines are actually above 1. So this means that a lot of these random portfolios with 10 stocks actually performed better when they were rebalanced every single minute than when we just had buy and hold. And if we look at the next plot, this is for random portfolios with 40 stocks each. Remember, the dataset only has 70 stocks, and these portfolios have 40 stocks each. And here we see a lot of these ratios between the rebalanced and buy and hold portfolios are above 1, meaning that most of the time these perform better than the buy and hold portfolios. And this is actually quite interesting, but we need to test this with a much larger dataset, let's say 1,000 stocks for 10 years. And if you have access to one of those datasets, then I would be very interested in hearing the results. You should be able to just reuse the source code that I have made. There are a few things that could go wrong in that source code. For example, I have removed all of the after hours and pre-market data points because those do not have the same sampling frequency, and it will create phantom data points for those stocks that don't have data points there. And this may distort the results of rebalancing. There are still a few phantom data points here and there in the data, and that may also distort the results. Another problem may be that the floating point precision is not high enough. When you multiply a lot of floating point numbers, it may require higher data precision than used in the standard floating point data types in the computer code, and that may also be the reason why the rebalanced portfolios seem to look better than the buy and hold portfolios. I have done preliminary tests on this, and it doesn't appear to be the case either way. But if you want to test this with a much larger database, you also need to test those things in order to ensure that the computations don't generate errors that compound over time. But it looks promising. However, I actually calculate the annualized excess return we would get from this rebalancing every single minute, and it would probably only be somewhere between 0.5 and 0.9 percentage points, depending on the portfolio size. And that is assuming that there are no trading costs at all. So it's hardly worth the hassle in rebalancing your portfolio every single minute of every single trading day. You're not going to gain very much from it. Let us just look at this plot here, which is for intraday returns with 5-minute intervals. So this shows the ratio between the rebalanced and buy and hold portfolios. And once again, we see that most of these are above 1. So the rebalanced portfolios mostly perform better than the buy and hold portfolios when we rebalance every 5 minutes. And once again, I have calculated what this would mean in terms of excess return on an annualized basis. And this would be slightly higher than for the 1-minute rebalancing. Now it is somewhere between 0.6 percentage points and 1.3 percentage points, depending on the portfolio size. I think this might be interesting to research for something like a large pension fund or something, to see if they can maybe not do fixed interval rebalancing, but more like an adaptive rebalancing, so that whenever a stock has moved up or down 1%, it rebalances that stock relative to the rest of the portfolio. And maybe they don't have to do thousands of trades every day. Maybe you can squeeze a little extra return out of that, but you need to test it on a much larger dataset with like 1,000 stocks at least and let's say 10 years of intraday data. And of course, we would also like to know, why does this seem to work for intraday data and not for daily or weekly or monthly returns? One reason might be because the correlations between the stocks for each time step, so whether it is a 1-minute interval or 5-minute interval or a daily stock return, the correlation between these stocks is much lower for the very short intraday intervals, as we can see in this plot here. So the purple distribution here is for 1-minute intervals, the green distribution is for 5-minute intervals, and the red distribution is for daily returns. And I realize now that it would have been nice to plot it for the weekly and monthly returns as well, but I didn't think of that at the time I made this plot. But what the plot shows is that for those 70 stocks that are common between the intraday dataset and the dataset with daily stock returns, the correlation between pairs of these 70 stocks is much lower for the intraday stock returns than for the daily stock returns. And maybe that is the reason why the rebalanced portfolios might actually perform better than the buy and hold portfolios when we have short intraday 1 or 5 minute rebalancing intervals. Again, this is something you are very welcome to investigate. And that brings us to the conclusion, and you can find links below the video to this paper, as well as the computer code and data. Good luck!